Alright, let's continue where we left in the last class. We already spoke about the syllabus, the exam format, and now it's time to start off with the conceptual framework. Yeah, so I'll cover the conceptual framework. This topic, this topic will be tested in your multiple choice question, but it's also a good topic for us to understand how to make decisions. How do we think? Yeah, how do we think in your F7 when you face a question? Because you see, when you do financial reporting, we are now following the IFRS, the International Financial Reporting Standards. We are no more under the GAAP, right? The key difference between your IFRS and your GAAP, we all know that GAAP is rules based. We all know GAAP is industry based. Whereas IFRS is very principles based. Okay, and it is applicable to all industries. Yeah, applicable to all industries. Whereas GAAP is every company, every industry. Insurance will have its own accounting regulation. Banking will have its own. Manufacturing, hotel, service industry will have its own specific regulation. In US, every state has its own regulations. Yeah, so it's all based on rules. Whereas in IFRS is a framework of thinking, of applying a principle, and then we can apply it to all transactions. Okay, so now I'll explain to you about the characteristics, what is the background of this IFRS. So firstly, I want to talk to you about the objectives. So objectives of financial statement. What is the objective of financial statement? They have already made it clear to us the objective of financial statement under the conceptual framework is for the users, in this case the investors and creditors. Okay, how do they have all the relevant information? So what do we say? Relevant information. Okay, relevant information for what? To make decision. Yeah, what is the objective understanding? To make decision. What decision? Decision whether to continue to provide resources to the entity. Okay, so I want to give every sort of information that will make the investors and creditors decide, should I continue to provide resources to the entity or not. So that's what you need to think about when you are presenting the financial statement. It is a relevant information. It's not for the sake of giving information. It has to be used for decision making. Okay, that is the objective. Then we have the qualitative characteristic. Now this is the highlight which will be in your exam. The qualitative characteristic of a financial statement under the conceptual framework. Now these qualitative characteristics are divided into, firstly, it has to be, we have fundamental characteristics and we have enhancing. Okay, Now let's see which are the fundamental. Fundamental is divided into two. Okay, which are these two? Oh, hold on. So fundamental. This one will be your relevant, and the second one will be your faithful representation. Faithful representation. Okay, now what do you mean by relevant? Relevant, we learned earlier that anything that helps me to make a decision is relevant. Okay, so we say financial statement should not be just for the sake of information, but it also should help the user to make decisions. This is the reason why we have the concept of materiality. Yeah, back in campus, back in school, we used to learn that everything should match. $5 also cannot be missing from the financial statements. True enough, if there is some missing figures, it shows there's weakness in the controls. But as far as financial statements are concerned, it is not relevant. $5 for a company sales of even 100 million is not relevant. So materiality is an important concept. So we only say items which are material. For example, in F8 we learned that 5% to 10% of PBT, profit before tax, is considered material. So what I want you to know is materiality is a product of the concept of relevant. Okay. Then we have this concept of we have to have faithful representation, which means we need to be true and we need to be fair. True means what? True means it is the what do you mean by true? True means that the financial statements have actually reflects the actual economic phenomena. Yeah? Actual economic phenomena. Okay, the actual economic activity of a company. Okay, what is fair? Fair means you have already complied with accounting standards. Now, these things will probably not ask to you directly, but there is a very underlying concept here which is always tested in F7 exam, which is the substance over form. Please highlight this part. Substance over legal form is the result of the fundamental characteristics of financial statement, which we call faithful representation. Okay, so why we have substance over form? What do you mean by substance over legal form? In financial reporting, we should focus on the legal side of things, how the transaction is recorded legally, right? Or should we see the substance of the transaction, meaning how it is the essence? So I'll give you examples about substance over legal form, because this is regularly coming in your exam. But please remember, legal law can be manipulated. Yeah, and that's why we say lawyers are liars, because law can be used to fit the client's needs, whereas accountants, they cannot fit to clients desires and needs. We need to show the actual transaction as it is. We need to show what is the essence of a transaction. Okay, so I give you some examples about substance over legal form. Number one example, please get this down, some examples to show your substance over legal. Number one example is you have redeemable preference shares. Okay, Now, redeemable preference shares. What do you mean by this? Preference shares is the legally is what? Legally it is a equity. Why? Because it is part of your share capital. Correct. Right? It's part of your share capital. But we have an additional clause there that the preference shareholders wants the company to pay the shareholder back the money. So they say, I want you to pay me back after 5 years. So it is redeemable, let's say after 5 years. After 5 years, I have to pay back. And every year that I need to pay this preference shareholders, I need to give them a fixed 10% dividend. Okay, so you see, legally I'm going to pay him 10% dividend, and legally I'm a shareholder, but the contract says I have to pay him back after 5 years. Now, you see, what is the substance of this transaction? Is it a equity or is it a liability? We have a choice. Is it a liability or is it a equity? Legally, yes. Yes. But you look at the essence of the transaction. If you are a lender, then you can say pay me back after 5 years. If you are a lender, you can say, okay, you got to pay me fixed interest, right? So this 10%, even though it is called dividend, in essence is what actually? In essence, it's like an interest. Can you see? So in substance, we say it is a, though this is a dividend, okay, though this is a dividend, I will not record this as a dividend, I will record this as a interest, which means I will record this under finance cost. There. Can you see? Okay. So I will record this liability because that's the substance of the transaction. I will record this as non-current liability and I will charge a finance cost instead of dividends. Finance cost instead of dividends. Okay, that is one of the example of substance over form. Let me give you more. Building useful life is 20 years. Okay, we have leased or rented for 18 years. Okay, 18 years. So I have a question. My question is, should I record this as a rental, meaning as an expense, or should I record the building as an asset? Because it looks like I have rented it for so long, it's like I am actually controlling the asset for such a long period of time. So what do you think? What do you think? This is an expense or an asset? Now, legally it is a rental because I have signed the rental. I don't own the asset. Okay, I don't own the asset. I'm going to pay yearly. Okay, so legally it is a rental. But let us see, legally it is a rental. But now do we look at this? 20 years useful life. I am renting it for 18 years. We need to see what is the definition of asset. Asset definition is what under conceptual framework. Asset is a resource. It is a what? It is controlled by the entity, right? Resource controlled by the entity, and it gives me what? Future future economic benefits. Can you see that? Future economic benefits. Okay, it does not say own. It does not say own. It says control. Okay, so now you look at, and it must give me future economic benefit. Now you see, I have rented this for 18 years. Is it a resource? Is building a resource? Yes, building is a resource. We all know that. Then am I controlling it? I'm controlling it for the majority of the useful life of the asset. So I have control because I have signed an 18-year rental. Can you see? You can say, oh, legally it's still a rental. I want to record it as an expense and then hence reduce our tax. You see, companies would like to manipulate it like that. But the fact of the matter is, accountants must show the substance. So I say, hey, I control the asset for 18 years and I'm getting future benefit. Future benefit means what? Next year is also mine. Following year also mine. So it's giving me future benefit. So legally it is a expense, but substance we say that it is a asset. So we follow legal. We follow substance. We don't follow the legal. Can you see that? How this principle of faithful representation, which resulted in that we need to show substance over the legal form, has resulted in changing everything. We don't see now we record things based on what the contract says. We analyze the contract and we say essentially what it is. Is it an expense or is it an asset? Is it like redeemable preference shares? Is it a liability or is it an equity? You see, we would like to analyze it in such manner. Okay, now another thing I give you. For example, you have a parent, you have a subsidiary 60%, then you have revenue, parent 300 million, subsidiary 200 million. So what would be my total revenue? Should I say 500 or should I say 300 plus your 200 multiplied by 60%, because I only own this company 60%, so this will become 300 plus your 60% of 200 is 120. So I should only record 420. Which one is the right consolidated revenue, 500 or 420? That is the question. Now, how do we think again? We think again on substance over legal form. Legally, I only own 60% of the subsidiary. So I should only record 420. But look at the substance. The thing is, parent, the moment it has 60%, what do I have? I have control. The moment I have control, parent has control, meaning when they go to the subsidiary, they can talk to all the employees. You cannot stop the parent investors or parent management to say, hey, you only talk to the 60% of the employees because you only 60% shareholder. Cannot. Can you see? They already have control. Because they already control, therefore it is part of the parents group. So this, even though 60%, I will record the full revenue of 500 as the group's revenue first. Then of course we have calculation and how much of the profit we need to share with the minority shareholder. But in essence is what? This $500 is the revenue of the group first. That's why we say consolidated revenue is 500, even though I cannot take all of it. Okay, so that's how substance over legal form affects many aspects of financial reporting. Okay, I hope you get the essence and a mindset of how we think in the financial reporting. Okay, so two very important part of the fundamental characteristic is number one, relevant, number two, faithful representation. Now going back, I hope you got that. Going back, what are the enhancing characteristics? Yeah, qualitative character, fundamental, and enhancing. What are the enhancing characteristics? Are all your financial statements must be comparable, must be verifiable, must be understandable, must be time bound, must be on time. Verifiable is a keyword because anything on the financial statement, the user is assuming there is a supporting evidence. You cannot put any figures from the air. Yeah, everything must be validated, meaning you cannot practice money laundering. Yeah, money laundering is a major issue, right? Because it is the transactions come without any source. Now we have the recent tax amnesty in Indonesia. We also have a problem. Suddenly you have a new asset and we don't have the source of funding. Is it from a liability or is it from previous off-balance sheet transaction? So you need to have verifiability as part of the. It must be comparable. You cannot keep changing your accounting policies without any significant reasons. It must be understandable. The language you use in the disclosure notes must be clear and must be time bound. So this is the qualitative characteristics of financial system. So understand number one, the objectives, understand the qualitative characteristics. Now moving on, I would like to, by the way, that one is time bound, time bound. Moving on. Okay, moving on. I want to bring to your attention the underlying assumption. Please get that down. What is the underlying assumption? When you prepare your financial statements, what is the underlying assumption? There is this thing called going concern. Yeah, going concern is an important item because what is going concern? First of all, it is the ability of entity to continue in the foreseeable future. When you say foreseeable future, typically we say that this company can continue for the next 12 months after the year end. Okay. Now what is the problem? Why do we talk about this in financial reporting? The issue is if going concern assumption is not appropriate. Why will it be not appropriate? Why will it be not appropriate? Due to the presence of what? Presence of material uncertainties. What do we say? Material uncertainty. If the company is facing material uncertainty, for example, they have significant budget deficits. For example, they have lost key person. For example, legal license is already of an issue. Okay, so because of this, going concern assumption may not be appropriate. And if going concern assumption is not appropriate, what is the impact on the financial reporting? Yeah, if not appropriate, what is the assumption? We need to use breakup basis. What basis? Breakup basis. Meaning all the assets, liability, all the components of the financial statement we have to record at the realizable values. We cannot use any other forms of measurement, it's only realizable value. So you imagine you have financial statements, everything recorded at the historical cost or even the fair value, but the company is going to collapse in the next 3 months. So the investors are not getting the right information about the company because you made it appear as if everything is okay. Yeah, so you need to know there is an impact of going concern. So now we're talking about measurements. What are the measurements allowed in the conceptual framework? This is the last part of the financial statements conceptual framework. Measurement. The concepts that are allowed: number one, you can record your assets liabilities at the historical cost. Historical cost. You can record it at the current cost. What do you mean by current cost? Meaning, if you this is the if historical cost is the cost at the time of acquisition, yeah. Okay. Now, current cost is what if you were to get a asset similar like this, okay, similar to our current asset. What will be the value at the reporting date? So current cost is what? Is the cost of similar asset at the reporting date. Reporting date. Now, exam question sometimes ask you something called replacement cost. This is interesting because if you are going to measure your assets at the replacement cost, yeah, what is the impact? The impact is like this. Yeah, you have let's say a building, not say building lah, maybe we change it to machine. Okay, this machine is already, let's say the cost is historical cost is 10,000. Okay, and we have already depreciation for, let's say we are doing this over 5 years, useful life 5 years. That means $2,000 per year will be the depreciation. So total depreciation is already 4,000. Maybe that means we already use it for after 2 years. So after 2 years, the depreciation accumulated, of course, accumulated depreciation is 4,000. So what is the carrying value of the asset? Carrying value of the asset is $6,000. Now, exam question may ask you that a new machine like this in the market, new machine exactly like this in the market currently cost, new machine in the market at the reporting date, of course, at the reporting date, let's say it costs $15,000. Yeah, maybe the prices have increased or decreased, whatever is the situation. So I have a new machine similar to this. Now it's costing 15,000. Now when I want to save the replacement cost, we say, okay, to get a new machine at the reporting date, the replacement cost will be 15,000. But don't forget that we have to, if you want to record in our financial statement, we need to minus off the depreciation of the asset, because we need to make it comparable. So we said, okay, if 15,000 was the value of the asset, and if it was what you call that, spread over 5 years, meaning each year will be how much? 3,000. So depreciation each year will be 3,000. And if I want to make it comparable, that means if it is a 2 years depreciated asset, so that means the depreciation will be $6,000. Can you see that? The depreciation will be 6,000, and hence the replacement cost, yeah, so carrying value of replacement cost of machine will become, how much is this? This is 9,000. This is what we call replacement cost. Many students are confused because they say, "Sir, the replacement cost is only 15,000 because the new machine will cost 15,000. Why don't we record 15,000 only?" But you need to make the machine comparable to our current machine. The current machine is already a 2 years depreciated machine. So even if you have a new machine, you have to make the same assumption that what if this machine is a 2 years depreciated machine. So that's why we need to calculate that, oh, this 1 year depreciation, 15,000 over 5 years means 3,000. 3,000 times by 2, 6,000. Therefore, my replacement cost will be 9,000. Okay, clear? This is how we calculate replacement cost, which is part of your current cost concept. So we have historical cost, you have current cost, then you have replacement cost. You also have the option of your, there is an additional component which we call fair value. You want to record at the fair value, which is also known as the market value. Yeah, of course, we'll learn the official definition later, what is fair value. But please understand, this is referring to the market value of the assets. Which assets? The market value of the current assets. Can you see? Market value of the current assets. It is not talking about market value of a new asset. This is market value of the current assets. Okay, so financial reporting framework allows us to record the assets at historical cost. It allows us to record it at the current cost. You can also record it at the fair value cost, and you also have an option to record it at the present value. Yeah, present value, meaning you have your future cash flows multiplied by your discount factor. Now, along the way, when you study IFRS, you will notice every IAS will tell you separately which is the best measurement for a certain item. For example, if you have to make a payment after 10 years, of course, it's best to record it at the present value, because your payment in the future is not reflective of the interest component. Therefore, we need to discount it to the present value. Okay, then certain measurements will require you to do fair value. Why? For example, if you have land, you bought the land at $10 million and you know the market value is higher, so you must reflect true and fair, right? So true and fair meaning you have to show that this is the market value of the asset. So, but understand the framework allows these measurements to be infuted into the into your different ISs. So when you learn your ISs from now onwards, I want to give you a framework of how to learn ISs in a simple way. Every ISs that you learn, yeah, how do you learning ISs? I want to have a framework so the following chapters will be easier for you. For every ISs, you think about this in this manner. Think about the definitions of the concepts, definition of assets, definition of liabilities, and then definition of provisions, definition. So learn the definitions of item because this will affect your treatment. Learn the recognition. So because everything has a recognition criteria in order to recognize it as an asset, in order to recognize it as a provision, everything has a recognition criteria. Once you say yes, this is part of a certain item, then the third item is your measurement. Yeah, how will I measure? How will I put my concept is correct that I should recognize this asset. I should recognize this as an expense. Now my question is, how do I measure it? How do I calculate it? So these three things should be in your mind: definition, recognition, measurement. In addition, also think about disclosure notes. But disclosure notes at F7 level may not need to go into the details because disclosure notes are more tested at your P2 level. Yeah, so disclosure notes. But do know them. You know, when you have extra time, go through some of the disclosure notes requirement. Okay, so what did we learn in this chapter? Number one, we learned conceptual framework has the objectives. What are the objectives? Number two, what is the conceptual framework qualitative characteristics? There are two, which is fundamental and enhancing. So I've given you what is fundamental and enhancing. After that, we have learned what is the underlying assumption. The underlying assumption is going concern. After that, we have learned what are the different measurements that the financial reporting allows you to use. Right? We have learned there is historical cost, current cost, fair value, present value. Okay, so this gives you a framework of how will you talk about the future ICs that you're going to learn in the next chapters. Right? See you in the next session. Thank you.